What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends impacting investments. I'm your host, Axel Christensen, Chief Investment Strategist for Latin America at the BlackRock Investment Institute. And this week, I'll be talking about where investors can find opportunities amid volatility in the markets and as geopolitical fragmentation plays out. Last week's jump in bond yields and stock stumble reaffirmed that we're in a new regime of greater volatility. We think emerging markets are relatively better positioned to withstand some of this volatility than developed market peers, even if they're not immune from a sharp hit to risk assets. Here's why. As global fragmentation plays out, countries and companies are increasingly prioritizing security and resiliency through industrial subsidies, export controls, and other tools over maximum efficiency. We see competing blocs emerging with multi-aligned countries based on national interests. We see supply chains rewiring as nations aim to bring production closer to home. We see supply chain rewiring benefiting selected emerging markets that offer valuable commodities and supply chain input. That includes oil from the Gulf states, India's industrial sector, Indonesia's metals, and Chile's lithium. Some countries, like Mexico, could benefit from developed market efforts to reshore production closer to home. That push includes the production of semiconductors, the technology powering artificial intelligence, and a key part of major emerging markets' tech sectors. Here's our market take. We assess what's in the price as we pivot to new opportunities. We flip our overweight to emerging market local currency debt to neutral and turn overweight emerging market hard currency debt instead on a 6 to 12 months tactical horizon. We had been overweight emerging market local currency debt since March, on attractive yields from emerging market central banks nearing the end of their hiking cycles and a broadly weaker US dollar. We began to reassess our view on local currency in July. Yields have fallen closer to US Treasury yields. Central bank rate cuts, like in Brazil and Chile, could put downward pressure on emerging market currencies, dragging on local currency returns. We get granular in emerging market stuff. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com/thebid.